Okay, let's unpack this. We've got a forecast sitting on our desk that, frankly, sounds like pure market euphoria. $200 out silver. I mean, that number forces you to pause, right? Especially when the current price is hovering around 60 bucks. But the analysis we're diving into today, and this comes from a very specific aggressive corner of the market, it's not based on, short-term excitement. No, our sources show silver recently staged this massive breakout. It's approaching its inflation-adjusted historical peaks. We were talking about a 94% year-over-year gain leading up to December 2025. That kind of rapid acceleration isn't just noise, it's a signal.
It absolutely is a signal, and that's exactly why we're here. We're doing a deep dive into analysis, specifically one published in December 2025, which laid out this technical and structural case for silver to hit anywhere from $100 to $200, and probably by early Q2 2026. So let's be very clear here. We are dissecting the mechanisms and the data points that fuel this kind of prediction. This is purely an exercise in understanding market dynamics, not investment advice. And to ground the conversation, let's look at the snapshot right before this analysis was published. The spot price was $61.84 per ounce. That was on December 10th, 2025. And when you see a 94% year-over-year surge, it demands that you look beyond the typical charts and ask, what is structurally shifting underneath this market?
Exactly. So let's get into the cold hard facts available at that moment. What does the market snapshot tell us about the sheer momentum of this price move? Because a 94% annual gain is one thing, but how fast was that acceleration?
The acceleration was dramatic. That 61.84 price point, it didn't just crawl there. It actually reflected a 20.74% gain just in the preceding month. This is really the hallmark of a market in transition, where resistance levels are just being breached quickly and decisively.
And when silver moves, we always have to check its relationship with gold, the gold-silver ratio. How is that behaving? Because that ratio, it so often tells us if the market thinks silver is undervalued relative to gold, or if the whole sector is just moving together.
Right, and what's fascinating here is that the ratio had recently declined to 71.9 to 1. Now, historically, silver is often seen as extremely undervalued when this ratio is really high, say, over 80 and 90. But 71.9, that's the lowest level we'd seen since 2021, and it's getting much closer to the historical mean, which is around 69 to 1. A declining ratio just means silver is outperforming gold. Strength is flowing into the cheaper metal.
And what about the physical stuff? Forget the paper contracts for a second. Were there tangible signs of stress in the supply chain that could justify that kind of move?
This is where the story gets really urgent. We saw tangible evidence of supply tightness in the COMEX inventories. These are the warehouses, holding the actual metal ready for delivery. By October 2025, those inventories had fallen below 210 million ounces. To put that in perspective, that's a massive drop from the 290 million ounces they held in early 2024.
That inventory drop is startling. It really is. It speaks directly to the physical availability of the metal needed for industrial demand. When you see nearly 80 million ounces just vanish from storage in less than 2 years, something fundamental is changing.
Absolutely. Less physical metal in the storage, coupled with that accelerating price action. It suggests a tightness you just can't dismiss as speculative trading.
So that's the physical inventory. But who is making this forecast? I mean, $200, it sounds like hysteria. What mechanism could possibly justify taking the price from $60 to triple its previous all-time high? Let's talk about Michael Oliver and his analysis.
Oliver's the analyst driving this, and he doesn't focus on short-term fundamentals. He focuses on long-term structural rotations. He uses something called momentum structural analysis, or MSA. And the premise is that assets spend these long periods just accumulating energy in a range, and when they finally break free on a relative basis, the move is massive and swift.
Okay, so what did Oliver's MSA find that was so unique in late 2025?
He found a monumental technical shift. In November 2025, gold, silver, and the miners all broke out of these massive 11-year ranges. And this is the critical part. They broke out when measured against the S&P 500. It doesn't just mean the metal's price was hitting new nominal highs, but that they were starting to drastically outperform the general stock market.
Wow, an 11-year range breakout? That suggests a huge coiled spring. We're not talking about a quarterly trend here. We're talking about a generational shift in capital allocation, money moving out of the general market and into hard assets.
Precisely. If we connect this to the bigger picture, this kind of relative breakout signals a systemic rotation of capital. It indicates investors are deciding that the risk reward in equities is drying up and they're seeking safety and, value in metals.
And speaking of value, you mentioned the historical valuation gap between silver and gold. How structurally far off is silver in Oliver's view?
Well, at the time of the analysis, silver was trading at only 1.4% of gold's price. Oliver argues this is a historically suppressed level. To find the real potential, he looks back at past bull market peaks like 1980 or 2011, where silver gained enough strength that its value reached between 3.5 and 6.5% of gold's price.
So if the price simply returned to the low end of that historical peak ratio, the math on silver's potential must be staggering.
It is. Oliver calls the predicted move a sudden tantrum repricing. He argues that commodities often make these explosive, rapid moves once they exit multi-year stagnation. He points to copper, which quadrupled in price between 2005 and 2006 after being range-bound for a long, long time. That's the template for silver's potential velocity.
But inflation-adjusted doesn't automatically mean it's a prediction. What's the catalyst that makes the market suddenly care about the 1980 price?
The historical context is key because it establishes a precedent for how the market behaves, especially when it's linked to fiat currency debasement. Silver famously hit $50 highs in both 1980 and 2011. If you take that $50 figure and adjust it for the loss of purchasing power in the dollar since 1980, the equivalent price is actually over $170 an ounce in today's context. The $200 forecast, while extreme, is simply suggesting the metal will return to or maybe even slightly exceed its real historical value.
So the timeline for this specific analysis is Q2 2026. Is this linked to some specific short-term event like a new tariff or a geopolitical crisis?
No, it's not reactive like that. Oliver links the $100 to $200 forecast to long-term fiat currency debasement and anticipated weakness in the broader equity markets. It's a systemic and monetary prediction. It's rooted in the idea that if the dollar continues to lose its buying power, hard assets have to reprice to compensate.
And this is where it gets really interesting because silver has this powerful dual role. Unlike gold, which is mostly a monetary store of value, silver is an indispensable industrial component. We're talking about the physical demand pressure coming from tech and clean energy sectors.
This is the non-negotiable structural problem. Gold can be held in a vault forever, but silver is consumed. It's often destroyed during the manufacturing process, and the need for it is only growing.
And the numbers are staggering, driven mostly by the global energy transition. Solar power production alone is projected to consume 261 million ounces of silver in 2025. That's a 5.5% increase year over year.
And that's before we even look at transportation. Consumption from electric vehicles, or EVs, is projected to surpass 90 million ounces. Semiconductors, 5G technology, they all add significantly to this requirement. And what makes this so critical is that silver has very few viable substitutes in these applications. Its conductivity, its unique properties, they're essential. They need the physical metal.
So we have rapidly rising essential industrial demand slamming right up against the supply issue we identified earlier. The inventory is dropping. What does the overall supply-demand balance look like?
It looks structurally insufficient. The silver market is facing what's projected to be its fifth straight annual deficit. The cumulative deficit from 2021 through 2024 was already 678 million ounces, and the estimated deficit for 2025, another 117.6 million ounces. That is nearly 800 million ounces that the market has had to pull from existing stockpiles over 5 years.
I had no idea the clean energy transition was this reliant on silver. That completely changes the way I think about this market. But why can't miners just dig up more silver if the price jumps to $70 or $80?
And that's the most critical structural constraint. The supply side is inelastic. You see, silver production occurs primarily as a byproduct of mining for other base metals like copper, lead, and zinc. For every 1 ounce of primary silver that's mined, 2/3 of the supply comes from mines that are actually focused on other metals.
Meaning even if the price of silver hits $100 tomorrow, you can't just flood the market with new supply. Ramping up silver supply requires ramping up copper production, which is a massive, capital-intensive, multi-year undertaking.
Exactly. The supply curve just cannot quickly respond to a price signal for silver alone. And this bottleneck ensures that any sharp increase in industrial demand has to be met by rapidly draining the available physical stockpiles, which is precisely what that COMEX inventory drop is signaling.
That structural failure point is key. Okay, let's shift focus from the nuts and bolts of industry to the dynamics of the trading floor. The paper market versus the physical market. What vulnerabilities exist in COMEX trading when the physical supply is so constrained?
Well, this raises an important question about decoupling risk. Physical shortages eventually put stress on the financial mechanisms. We saw COMEX open interest, that's the number of outstanding paper contracts. It dropped 22% between August and October 2025. This suggests traders are either exiting or switching to physical positions because they're concerned about the exchange's ability to guarantee delivery.
And if that decoupling risk intensifies, cash settlements, which are often used to close out paper contracts, they just can't substitute for the physical delivery required by these industries. A solar panel factory needs the actual atoms of silver, not a check for the difference.
As analyst Mike Maloney emphasizes, price mechanisms exist to address scarcity. When the physical metal just isn't there, the price has to go high enough to destroy demand from non-essential users and ration supply to the most critical applications. If the paper market fails to bridge that physical gap, the price of physical metal can detach and detach dramatically from the paper price.
Which brings us to the broader economic backdrop that makes a massive repricing even possible. We're not talking about silver in a vacuum here, but as a reaction to systemic issues in the global economy.
Precisely. If we connect this to the bigger picture, the source material points out that over a century of fiat currency expansion has just seriously eroded purchasing power. When we talk about fiat currency debasement, we simply mean that slow, quiet erosion of the dollar's buying power. And at the same time, analysts are looking at the stock market and they're observing laborious highs. It's a conversational term for these slow, painful ascents that are structurally similar to the market tops we saw in 2000 and 2007. They're highs built not on fundamental growth, but often sustained by cheap liquidity.
So we're saying these asset bubbles have been sustained by central bank policy.
Exactly. Broad money supply growth, known as M2, which you can think of as watering down the financial pool that, coupled with historically low real interest rates, has sustained these high valuations. The analysts are suggesting that the inevitable shift away from this monetary environment will fuel silver's ascent as money seeks refuge.
What are the potential catalysts that could prompt this broader asset shift out of equities and into metals?
The source material suggests that strains in bond market liquidity and declines in traditional retirement accounts, like 401ks, could prompt a massive rotation. If those traditional investment pillars start to wobble, people seek tangible assets. We're already seeing central banks globally increasing their gold purchases, which aligns perfectly with this perception of a growing need for monetary alternatives right alongside silver's ascent.
A thorough deep dive requires balance. A $200 forecast is aggressive by any definition. What potential headwinds or counterpoints does the source material offer against this extreme prediction?
We must always approach these predictions with caution, and there are countervailing forces. While the deficit figures are huge, some projections indicate that the global silver deficit may narrow by about 21% in 2025. This is due to a mix of things. If prices get very high, industrial users might moderate their demand, and you might get a slight expansion of supply from existing mines.
And what about the overall economic landscape? That could change the entire trajectory if central banks somehow engineer a soft landing or if technology suddenly finds a substitute for silver.
Absolutely. Central bank policies or major macroeconomic shifts could influence trajectories very differently than predicted. For instance, a sudden, sustained rise in real interest rates might temper the exuberance in all commodities, including silver. So we reiterate the necessary caution. This analysis presents factual data and structural observations for educational purposes only. It is not and should never be taken as financial advice. To sort of summarize the core tension for you, silver's potential is based on this powerful intersection of two forces. First, you have a clear technical breakout. Michael Oliver's 11-year range analysis suggests a massive structural shift of capital away from equities and into metals. And second, there is non-negotiable structural shortage driven by clean energy industrial demand, which cannot be easily met by the current inelastic supply structure.
That duality, the monetary escape hatch combined with the industrial necessity, that's what makes this particular surge so compelling. We've seen the physical inventory draining, the COMEX open interest dropping, and we know there is an essential technological need for the physical metal to power the solar and EV transitions. So the final provocative thought for you to chew on is this. We've established that the physical supply of silver is inelastic because it's a byproduct, and industrial demand for clean energy is not negotiable. What happens to the global manufacturing sectors, from solar panels to electric vehicles, if the paper market ultimately fails to bridge that gap and the price is forced to rise sharply just to ration the genuinely scarce physical metal? This raises a really important question about the true economic cost of the green transition, and it's one worth exploring further in your own research.
Indeed. We encourage you to continue exploring the fundamental ideas and data we've discussed today.
Thanks for diving deep with us. We'll see you next time.